The repo market just froze, and if that sentence sounds boring, it's because the repo market is designed to be invisible. It's supposed to function so smoothly that nobody talks about it. But when it seizes up, everything else starts to wobble. Stocks, bonds, banks, credit, and yes, even gold and silver. Because repo is not a side market. Repo is the plumbing that keeps Wall Street liquid. So when you hear repo stress, don't picture a niche corner of finance having a bad day. Picture the funding engine that lets major institutions finance massive positions suddenly getting tight. Picture the system discovering that cash is more scarce than the headlines admit. And then picture what happens when the world's most leveraged ecosystem realizes it might not be able to roll its financing on easy terms. That's when markets don't crash because beliefs changed. They crash because oxygen got removed. Now, before we go any further, we need to be disciplined about one thing. A repo freeze doesn't always look like a dramatic halt. It can show up as rates spiking, collateral becoming harder to finance, haircuts increasing, or certain counterparties quietly stepping back. The surface might look calm. The behavior underneath is what matters. And behavior is exactly what we're going to decode today. In this breakdown, we're going to answer 4 questions. First, what is repo in plain English, and why does it matter more than most people realize? Second, what does it actually mean when repo seizes up, and what are the warning signs that the public usually misses? Third, why does Wall Street panic when repo gets tight, even if the economy hasn't officially changed in a week? And fourth, what should you watch next? What signals tell you whether this is a temporary funding hiccup or the start of a broader liquidity event? One sentence to anchor the entire video. When repo tightens, leverage becomes fragile. And when leverage becomes fragile, prices can fall faster than fundamentals can explain. Let's define repo without the jargon. Repo is short for repurchase agreement. In practice, it's a collateralized loan. One party needs cash, another party has cash. The borrower hands over high-quality collateral, usually Treasury securities, and receives cash. The borrower agrees to buy the collateral back later at a slightly higher price. That price difference is the interest rate. Why is this so important? Because this is how the financial system funds itself day to day. Banks and dealers use repo to finance bond inventories. Hedge funds use it to leverage trades. Money market funds use it as a place to park cash. The whole system relies on the assumption that repo funding is available, cheap, and rollable. If repo works, everyone can breathe. If repo gets tight, everyone starts checking exits. Now, what does it mean for repo to seize up? It can mean different things depending on where the stress is. Sometimes it's a rate spike. Repo rates suddenly jump above where they normally trade, signaling that cash is scarce or demand for funding is surging. Sometimes it's a collateral issue. Certain collateral becomes less accepted or requires larger haircuts, meaning the borrower must post more collateral for the same cash. Sometimes it's a counterparty issue. Lenders become selective because they don't trust certain borrowers. And sometimes it's a balance sheet issue. Banks and dealers step back because regulations, quarter-end constraints, or risk limits make it unattractive to provide funding. But the common thread is the same. Funding becomes more expensive or less available. And when funding becomes more expensive or less available, the system has to deleverage. This is where the dominoes start. A dealer financing treasuries can't roll repo as easily, so they reduce inventory. A hedge fund running a leveraged basis trade faces higher haircuts or higher funding costs, so they cut positions. A money market fund sees uncertainty and shifts to the safest exposures, reducing liquidity elsewhere. The result is forced selling, not because people decided their assets are worth less, but because they need cash and balance sheet space. That's why repo stress can suddenly show up as broad market volatility. It's not that everyone woke up and changed their mind about the future. It's that the financing of the present got harder. Now, here's the critical misunderstanding. People assume the Fed controls repo and therefore nothing can go wrong. It's true that the Fed has tools, the standing repo facility, open market operations, and the ability to inject reserves. But the system doesn't only depend on the Fed's willingness, it depends on transmission. It depends on whether the liquidity reaches the right nodes at the right time, whether the collateral is acceptable, and whether private counterparties are willing to intermediate. In other words, the Fed can provide a backstop, but it cannot force trust. Repo is also where you can see stress before it shows up in official narratives. The reason is simple. Repo is the market of necessity. It's where institutions go when they must fund positions. When necessity bids for cash, the price of cash rises. That's repo stress. Now, why does Wall Street panic? Because modern markets are built on leverage, stacked on leverage. In that environment, liquidity is not a convenience, it's survival. A small change in funding terms can wipe out an entire strategy. Take the basis trade as an example. A hedge fund buys treasuries and shorts treasury futures to capture a small spread. It looks safe because it's hedged, but it's leveraged because the spread is small. If repo funding costs rise or haircuts increase, the trade becomes unprofitable or the fund can't finance the position. Then the fund must unwind. Unwinding means selling treasuries and buying back futures. If many funds unwind at once, treasury markets can get disorderly. That disorder spills into risk assets. Repo stress also forces banks to make choices. Their balance sheets are finite. If they need to conserve capacity, they will reduce market making, widen spreads, and become less willing to intermediate. That reduces liquidity exactly when the system needs it most. So when you hear repo seized up, the real meaning is this. The system is being asked to operate with less oxygen, and the first response is to dump weight. Now, let's connect this to the broader picture, because repo stress is not just a technical story. It's a narrative story, too. It reveals something about the state of the system. A healthy system can absorb shocks. It has buffers, ample reserves, willing intermediaries, stable collateral valuations, and confidence that funding will roll. A fragile system runs hot. It operates close to its limits. It needs funding to stay cheap, volatility to stay low, and confidence to stay intact. So, when any of those conditions break, stress surfaces quickly. Repo freezes tend to happen in moments when the system is already loaded with risk. Maybe asset prices are stretched. Maybe volatility has been suppressed for too long. Maybe balance sheets are constrained. Maybe Treasury issuance is heavy and the market is forced to absorb a lot of supply. Maybe the Fed is tightening or draining reserves. The trigger might look small, but the underlying vulnerability is structural. This is why Wall Street panics is not just drama. It's rational behavior in a leveraged world. If you know funding is tightening, you don't wait to see if it gets worse. You reduce risk now while you can. Everyone tries to exit at the same time, and that is how liquidity events escalate. Now, here's where people get confused about the Fed again. If repo stress emerges, the Fed can respond by injecting liquidity. But that response can have consequences. If the Fed injects reserves aggressively, it can ease funding stress, but also signal that something broke. Markets can interpret it as confirmation of fragility. If the Fed doesn't inject enough, stress can spread. The Fed is often trying to balance stability with moral hazard, but markets don't care about the philosophy. Markets care about survival. So what happens next depends on the path of stress and the path of response. If repo stress is brief, say a quarter-end balance sheet constraint, then rates may normalize quickly and risk assets may stabilize. If repo stress is driven by a deeper shortage of reserves or a structural imbalance in collateral and cash, then the problem can persist. And persistent repo stress forces persistent deleveraging. This is where the story becomes important for gold and silver, even if this video is about repo. Liquidity crunches often hit everything at first. In a scramble for cash, people sell what they can sell. Gold can get sold to raise liquidity. Silver can get hit hard because it's smaller and more volatile. That can trick people into thinking metals are failing. But later, if the Fed responds with liquidity injections and the market starts pricing a policy pivot or renewed monetary expansion, metals often benefit. The sequence can be counterintuitive. First, sell everything for cash. Later, buy hard assets as the response arrives. That's why the timing matters and why your job is to watch signals, not slogans. Now let's talk about the early warning signs that a repo freeze is real and not just clickbait. Watch repo rates relative to policy rates. Watch for unusual spikes. Watch for persistent elevation, not a one-hour blip. Watch Treasury market liquidity. Bid-ask, spreads widening, depth thinning, strange price action. Watch funding-sensitive strategies coming under pressure. Watch for sudden risk-off behavior in equities and credit that seems disconnected from macro news. Watch for the dollar to surge as global demand for liquidity rises. And watch for the Fed's language to shift from confidence to monitoring conditions. Another underappreciated signal is the behavior of collateral. If the highest quality collateral, like on-the-run treasuries, becomes special, meaning borrowers are willing to accept lower rates just to obtain it, that can signal collateral scarcity or balance sheet stress. When collateral gets special, it tells you the market is fighting over the safest instruments. That is not a bullish sign for risk appetite. Now, what does over mean in a title like this? In markets, it's over usually means the era of easy funding and painless leverage is over, at least for a while. It means the system has moved into a regime where liquidity is not assumed. In that regime, volatility rises, correlations move toward one, and markets become more sensitive to funding conditions than to fundamentals. That is a major shift. And it's why repo matters. The repo market is where regimes change first. Section 4. So what should you do with this information? Not in the sense of a trade recommendation, but in the sense of situational awareness. Because the biggest mistake people make in liquidity events is treating them like normal days. First, recognize the difference between a liquidity event and a valuation event. A valuation event is when fundamentals change. Earnings collapse, defaults rise, growth slows, inflation accelerates. A liquidity event is when funding tightens and forced selling drives prices, regardless of fundamentals. Liquidity events are faster and uglier. They can create bargains and traps at the same time. The correct response is not panic, it's risk awareness. Second, watch the policy reaction function. Repo stress is one of the few things that can force the Fed to act quickly because it threatens market functioning. If the Fed steps in, it can calm funding. If it hesitates, stress can spread. So the key question is not only whether repo is stressed, but whether the Fed is expanding reserves and whether that expansion is sufficient. Third, track the follow-through. A true freeze doesn't resolve in one press release. It resolves when rates normalize, when collateral markets stabilize, and when intermediaries return. If you see repeated spikes, persistent wide spreads, and continued nervousness in funding, the problem is not gone. It is recurring. Fourth, pay attention to who is forced to act. Liquidity events reveal weak links. Highly leveraged funds, crowded trades, and balance sheet constrained dealers are the first to flinch. If you see sudden unwinds in specific strategies, that tells you where the stress is concentrated. Now, let's bring it back to a simple watch list. If you want to monitor whether repo stress is easing or worsening, focus on 4 things. 1. Repo rates and their persistence. A brief spike is noise. A sustained elevation is stress. 2. Treasury market liquidity. Watch spreads, depth, and abnormal moves. The Treasury market is the core collateral base. If it becomes unstable, everything else becomes unstable. 3. The dollar and broader funding indicators. Liquidity stress often shows up as a stronger dollar because global borrowers scramble for dollars. 4. The Fed's operations and language. Are they injecting liquidity? Are they expanding the balance sheet? Are they guiding the market toward calm or simply acknowledging volatility? Now the final point, because this is where people misread the entire episode. Wall Street doesn't panic because repo is bad optics. Wall Street panics because repo is the difference between holding positions and being forced to dump them. In a leveraged system, the cost of funding is the cost of staying alive. When that cost spikes, survival behavior takes over. So here's the clean summary. The repo market is the plumbing that funds Wall Street. When it tightens, leverage becomes fragile and forced selling can erupt. Repo stress can spread quickly because it hits the system at its most vulnerable point, funding. The next chapter depends on whether the stress is temporary or structural, and whether the Fed provides enough liquidity to restore normal functioning. If you want to understand what happens next, don't anchor to one scary headline. Watch the plumbing. Because when the plumbing fails, markets don't move politely. They move fast, ugly, and automatic.